Hello class, and welcome to the video lecture for accounting for property, plant, equipment, and intangible assets. Learning Unit 1 covers the calculation of the cost of purchasing one of these assets. First, let's review current assets, which you learned about in Accounting 110. Current assets are those assets that are used up within 1 year or one accounting cycle, whichever is longer. Examples of current assets include cash, accounts receivable, notes receivable, and inventory. Now we're going to look at assets that take more than 1 year to be used up, called long-term assets. There's two main categories. One category is called property, plant, and equipment. This is a category on the balance sheet listed under long-term assets. It includes assets such as land, buildings, and trucks. The second category of long-term assets is called intangible assets. When something is intangible, it can't be touched or seen. Examples of intangible assets include patents and franchise licenses. An important concept to grasp is that long-term assets in the category property, plant, and equipment, except land, are depreciable. This means we record the use of the asset over time as an expense called depreciation expense. Current assets are not depreciated. Before we learn how to calculate depreciation, we need to learn what is involved in calculating the cost of the asset. The cost of a long-term asset isn't just the price we paid for it. It's all costs involved in getting the asset ready for use. Examples of costs involved in getting an asset ready for use are freight charges, which are also called shipping charges, as well as any cost associated with assembling and installing the asset. Once you've determined all the costs involved, you add them up and debit an asset account, calling it machinery, equipment, or something else descriptive of what it is. Let's look at the example on page 592. Smith ordered a machine with a list price of $20,000. Terms 310 net 30. List price just means the price without any discounts. So let's review what 310 net 30 means. So Smith ordered a machine with a list price of $20,000, and the terms are 310 net 30, written just like this. Okay, so whenever you see numbers with slashes before the abbreviation with an N, it means a discount is involved. The 3 is the percentage of the discount, and the 10 is the number of days the buyer has to pay in order to get that discount. So 310 means Smith can take a 3% discount if he pays in 10 days. And that's from the date of the invoice. If he doesn't, then he pays the full amount without the discount within 30 days. So if he pays within 10 days, as it says here, it says he paid within the discount period, that's 10 days, he can take a 3% discount. So 3% times 20,000 is $600. So that discount is subtracted from the price to arrive at a net purchase price. His net purchase price is $20,000 minus $600, which is equal to $19,400. Now let's look at the other expenses involved in obtaining this machine. Smith paid $1,500 in freight, which means it costs $1,500 to have the machine shipped to him. He also paid $250 to bring the machine from the train station to the location it would be used. Then he paid $700 to install and assemble the machine, and $900 to build a special foundation to put the machine on. Add all these up, and the total price is $22,750. This is the amount that will be debited to the machine account when the journal entry is made to record the transaction. So let's journalize this transaction. We have a debit to machine for $22,750 and a credit to cash. Let's just assume he's paying cash for all of those items of $22,750. So this machine account is a general ledger asset account, and it's listed under property, plant, and equipment on the balance sheet. Now, what would happen if a year later Smith needed to make repairs to the machine? Repairs are not part of making a machine ready for use, so repairs are recorded as an expense as they occur. For example, if he paid cash of $2,000 for repairs to the machine, the entry would be a debit to repair expense and a credit to cash. There's an important distinction here. This is recorded as an expense because it's not part of making the machine ready for use. The cost of land also includes any expense involved in getting it ready for use. Some of these costs are commissions to real estate agents, surveying the land, or grading and clearing land. Land is also a general ledger account listed under property, plant, and equipment on the balance sheet, but since land has an unlimited useful life, it's never depreciated. Once land has been made ready for use, anything done to the land to improve it is recorded in a general ledger account called land improvements. The land improvements usually have a limited useful life and are depreciated. A common example of land improvement is paving for a parking lot. The parking lot pavement will eventually break and crack and need replacing, so its useful life is limited, even if it's a long useful life. Like machines and equipment, any expense to make a building ready for use is added to the cost. This includes any repairs needed to make the building ready. For example, if a business purchases an office for the purpose of giving the employees a space to work, but the plumbing in the office is broken, the plumbing must be repaired in order to prepare the office for use by employees. However, if the plumbing is fixed and the office is being used by employees, and let's say the break room sink gets clogged and a plumber is called to fix it, that repair cost is recorded as a regular repair expense. If land and a building are purchased together, the total price must be divided up between them and recorded separately because buildings are depreciated and land is not. If a new building is being constructed, the cost includes all expenses necessary to build it. So that wraps up Learning Unit 1. In the next Learning Unit, you'll learn how to do the calculations for depreciation.